Hello again, this is BBC News. Time now for the top business stories. I'm Sally Bundock. The big absence as the UK reports its highest number of daily infections since the pandemic began. Staff shortages is a major problem both in healthcare and industry. Rising wholesale energy prices means big problems for consumers as well as energy companies. But can and will the government help? And what does 2022 have in store for social media? We'll get an expert view on the most important trends. So let's now get down to business, and as you've been hearing, the UK, France and the United States have all registered new coronavirus records as the Omicron variant continues to spread rapidly around the world. The UK recording nearly 219,000 new infections in the last 24-hour period, the highest daily figure so far. Prime Minister Boris Johnson said that despite the huge increase in COVID cases, there is a substantial level of immunity in the population. But the weeks ahead are going to be challenging, that was his words, and some services will be disrupted due to staff absences. So in order to combat this, around 100,000 critical workers in the UK are set to take daily COVID tests from the 10th of January in order to reduce the spread of the virus to colleagues. It will be for key industries including food processing, transport and the border force. But business leaders had been calling on the government to cut the self-isolation period for people in England who contract COVID-19 from 7 days to 5. This in an effort to curb the labour shortages. But Boris Johnson said the current system would not change. Well, let's talk this through with Dr. Roger Barker, Director of Policy at the Institute of Directors. Good morning to you. So at the IOD, do you want the isolation period cut down to 5 days?
It would be very helpful if that were to happen. We did a snap overnight poll of our members, and around 46% find that they're facing significant staff shortages. So if we could reduce this isolation period from 7 to 5 days, that really would make a difference. But we're not public health experts. We'd only want to do this if it was viable from a public health point of view. But I was taken by something that Professor Chris Whitty said yesterday in the evening press conference. He said that a positive lateral flow test was a very good marker of infectious disease. Now, if a negative lateral flow test could actually be an indicator that actually someone doesn't need to remain in isolation, could that be something that the government could explore? Because I think we do need to find ways to alleviate these real staff shortages.
Yeah, it is a big problem. And when you say that quite a few of your members are experiencing staff shortages, which particular businesses or industries are impacted most?
I think it's really actually across the board, but you're seeing it particularly in the hospitality sector. You're seeing it in the food supply chain. The transport sector is very affected. And I think the problem here is actually this issue of staff shortages seems to be becoming the big problem of this wave of the pandemic, as big a problem as anything else. It's the problem which threatens to overwhelm the NHS, and it's the problem which I think threatens business. And that's why actually our business economic confidence indicator is at the same low levels that it was at during the last lockdown. There's no real prospect of government support on the horizon compared to the last time. So that there's the prospect of big tax increases and the ending of various business support schemes at the end of the first quarter. So it really is quite a worrying time for business.
We have seen some companies such as Iceland, you know, the supermarket retailers say we might have to just close stores, quite a few stores across the country in the short term. I mean, businesses are having to adapt to this, aren't they?
They are. And I think, you know, particularly the businesses that are customer facing. I think the businesses that are office based, they can make the adjustment quite easily, as they have done over the last year, back to home working. But those businesses where people have to be present, they have to be facing the customer or doing a job in situ, they really are faced with a problem at the moment.
OK, Dr. Roger Barker, thank you, from the Institute of Directors. Well, let's now talk about another challenge that's facing businesses, individuals and industry, and that is the rising cost of energy, which is a real issue right across Europe and other countries. In the UK, Energy UK, the industry's trade body, has warned bills could soar by another 50% unless the government intervenes. And since wholesale gas prices started to spike, more than 20 retail UK energy suppliers have collapsed. Consumers are currently protected from big rises in wholesale costs by a price cap set by the UK regulator Ofgem, but that is due to change in April. Well, let's discuss this with Dr. Craig Lowry, Senior Consultant at Cornwall Insight. Good to talk to you again, Dr. Lowry. So your concern about the months ahead, of course, many are campaigning, the government, there's talks ongoing, some going on Monday, in the run-up to this price cap ending at the end of March.
Yes, we've seen indications of a number of discussions relating to potential support mechanism or mechanism intended to alleviate the potential increase in domestic customers' bills from April this year in particular under the default tariff cap. The current indications that we have are that the cap will increase by approximately 50%. To around £1,900 per year from April, and then based upon where the market is at this point in time, potentially increase to well in excess of £2,000 a year for next winter.
Now, energy companies are proposing to the government a price mechanism which is going to be based on what they suggest is a government subsidy scheme. What are they proposing?
Well, wholesale prices currently represent around 40 to 45% of the typical household energy bill. So the approach that the companies are putting forward is intended to control that. So under the proposal, the wholesale price of gas and electricity that goes into customers' bills will be agreed in advance between the government and energy suppliers. That price will be set for a given period, such as a year, 6 months, and that will then be benchmarked against the prevailing traded wholesale market price that we see on a day-to-day basis. If the prevailing price rose above this pre-agreed level, then the government would effectively pay suppliers the difference, meaning that the immediate cost to customers through their bills would not increase. Suppliers would be insulated from the wholesale price rise, and that would work conversely as well. So if the prevailing price fell below that agreed level, then the suppliers would pay the government the difference. So the key is, if this mechanism comes in, what is the level of the pre-agreed price? How is it set, and how frequently it changes?
Do you think that is a viable solution to this problem that we're experiencing currently?
Well, wholesale market intervention of this kind really hasn't been seen in the post-privatisation era of the UK energy market. And if anything, it's got parallels with some of the approaches we saw under nationalisation. I think the challenge that we would have with such a mechanism is that that policy would risk blunting the traded wholesale price as a signal for investment in the energy sector at a time when higher levels of spending in energy and energy infrastructure are needed to help enable or facilitate the net zero transition. So there are a lot of potential consequences, I think, which would need to be considered with such a policy if it was to be brought in.
Okay. Dr. Craig Lowry, thank you for your insight on that. And needless to say, we're keeping a very close eye on discussions between the government and energy industry leaders. So we'll update you if we get any further news. But now let's focus on the world's largest economy and the multiple headwinds it faces this year. So despite bouncing back in 2021, growth in the US economy may be tempered by inflation, supply chain disruptions, and of course, Omicron threats. And then we have the central bank possibly tightening quite a bit this year. Our North America business correspondent Michelle Fleury has a look.
The US economy defied expectations in 2021. Vaccines, as well as helicopter money from the US government and support from America's central bank, helped set the stage for a dizzying recovery from the deepest downturn since the Great Depression. Corporations enjoyed fat profits. The stock market soared, meme stocks became a thing, and cryptocurrencies burned hot. So now what, especially with Omicron? Can 2022 match that performance? You may have noticed that prices are going up. Inflation is back in many parts of the world. And here in the United States, where it's near a 4-decade high, it's a major concern.
The risk of higher inflation becoming entrenched has increased.
The best tool America's central bank has to control rising prices is to raise interest rates. And the Federal Reserve has penciled in 3 rate hikes for this year. The danger is, if it overreacts, it could kill off the recovery, or worse still, cause a recession. Another issue troubling Fed policymakers is the labour market. Unemployment has come down. In December it stood at 4.2%, but that's still above the pre-pandemic level of 3.6%. And there are other risks too. Omicron could worsen supply shortages. We're already seeing the havoc that staff shortages are causing at airports with flight cancellations. And it could push back the time frame for when people start to feel comfortable going back to the office to work. All of this has led economists to cut their growth forecasts for this year. Goldman Sachs, for example, trimmed its prediction from 4.2% to a more than respectable 3.8%. So if economic growth ground to a halt at the start of the pandemic before taking off to the moon in 2021, then if all goes well, the story of 2022 is likely to be one of rebalancing.
That there is Michelle Fleury. Well, we have Mark Ostwald with us now, Chief Economist and Global Strategist at ADM ISI. Good morning to you, Mark, and Happy New Year. So you were listening to all of that. Give us your take on the year ahead. And if we look at the US to begin with, the risks posed.
I think quite rightly the risks posed by the Federal Reserve overreacting to inflation is definitely a very real one. It's above all a risk which applies to all central banks around the world, simply because there isn't actually a lot they can do about energy prices, and energy prices are key to all of this inflation risk that we have in the world. It is going to be more a case of fiscal policy, and it's also going to be a risk. The US is actually better protected on the energy side because, as we've seen, it is now actually benefiting from the natural gas shortage in Europe. So it is better on that front, but I think really where its greatest dependency is on the movement of people and on labor skills. It's less a question of people moving around. I think it's a question of actually people retiring and labor shortages being there and being able to adjust.
And that's something we're seeing in many countries, isn't it, Mark, actually? People who stopped working when the pandemic began, they downed tools and have actually decided to not go back into the labour force. It's a real problem for many industries.
It's a problem for many industries, and it's also even a bigger problem because when the world economy rebalances, as Michelle was talking about, we don't know where it's going to rebalance to. What it's not going to rebalance to is where we were before. This has created fundamental changes in the global economy, and I think those are not to be underestimated. I think the other biggest market risk, and this is a risk to the economy as well, is there's too much concentration risk. People have been investing in certain things because they think they're an unalloyed good. And that leaves us in this vulnerable position of when we get uncertainties created by, say, a new strain of the pandemic, by labor shortages, by supply chain shortages, we suddenly find people panicking, particularly if central banks make a false step. And central banks have to tread really, really carefully.
And I'd like to get your thoughts on China, Mark, because much earlier in this programme we were hearing from our correspondents based in China about these severe lockdowns taking place, just a few cases in some cities, millions of people living in these cities, and yet them China locking down. There is quite a concern about growth in China this year as well, isn't there? And if they go ahead with those sort of policies, that will hit economic growth, won't it?
It certainly will hit economic growth, and I think this is one of the bigger risks that we've got in the world, that no one has a consistent policy in reaction terms. China has a zero tolerance policy that will disrupt supply chains and create a lot of problems elsewhere, and it will definitely increase inflationary pressures. And the fact that we get demand drop-offs because of this also creates a greater problem in the commodity markets, because suddenly people are saying, well, demand from China isn't going to be so good. and then you'll get another upsurge. So the biggest problem with the China sort of policy is you get these big swings in demand from China, which people find very difficult to deal with.
All right, Mark, we have run out of time, but nice to see you again. We'll see you again soon. Mark
Pleasure.
Ostwald there from ADM ISI. You are with BBC News still to come. What does 2022 have in store for social media? We'll be getting an expert view on the important trends to watch out for.
Welcome to Click. We're outside again. Sensors to track dangerous hotspots.
The robots are operating like a swarm of bees would.
I'd love to be a cyborg.
It won't be long before we're all living in this virtual universe. Spencer, where are you? It looks like I really shouldn't be having salt.
We might be able to stop or even reverse the aging process. I've just sat here and controlled things with my brain.
It's like technology telekinesis, isn't it?
The race is on to decarbonise aviation.
Cleaning up the stuff that comes out of those.
AI is changing the world.
London to Paris in half an hour.
Touchless coffee, driverless cars. You can virtually try on clothes.
Can we take it for a spin?
That's Click, Saturday and Sunday at 12:30 on the BBC News channel.
This is BBC News. Let's remind you of the top stories. A Chinese city of more than 1 million people is under lockdown after 3 reported cases under the government's zero COVID strategy. The congressional panel investigating last year's attack on the Capitol says it wants to question a US TV host about text messages he sent to Donald Trump. Shares in China Mobile have started trading in Shanghai, rising by more than 9% at the open. It's a homecoming for the telecommunications giant that was delisted on Wall Street after the Trump administration moved to restrict investment in Chinese tech firms. Well, Mariko Oy has been watching this today for us in our Asia Business Hub. Nice to see you, Mariko. So how has China Mobile done? It sounds like a good debut.
Yes, it was. And if you remember, it was one of the 3 state-owned Chinese telecom companies which were delisted from Wall Street about a year ago because of a new rule introduced by the Trump administration. And China Mobile, which is, of course, the world's biggest phone operator by total subscribers, it's the last to go public in Shanghai. By raising almost $8 billion, it is the country's biggest public offering in a decade. And the company says it will be using the cash to develop projects like premium 5G networks. And it is also expected to be one of many homecoming listings for Chinese companies because that US policy to clamp down on investments in Chinese tech giants, it's still in place. And we're waiting for, of course, China's ride-hailing giant Didi to take its shares off the New York Stock Exchange and move its listing to Hong Kong. Now, Didi is one of typical examples, if you like, of Chinese tech giants, which came under enormous pressure at home, especially after it pushed ahead with its US IPO. The app, for example, was removed from app stores in China a few days after its listing. And basically, Beijing is very sensitive about data, and by US regulators forcing Chinese companies to go through proper auditing, just like any other foreign companies which list there, it's now making them nervous about those data that could be made available to the American government. And China's national regulator just today said that any Chinese company with data from over 1 million users must have a security review before listing shares overseas. So these tensions between the world's 2 biggest economies and pressure on those Chinese tech giants that seem to be here to stay.
OK, thank you, Mariko. Nice to see you. Let's bring you some other business stories. The US car giant General Motors has lost its title as America's top car seller for the first time in 90 years. Japan's Toyota claimed the top spot, selling more than 2.3 million vehicles last year, up 10%. GM said its sales, which fell 13%, were hurt by the widespread shortage of semiconductor parts that's been affecting the auto industry. The Detroit company had ranked as the #1 US car seller since 1931. Burger King will sell vegan nuggets across the UK as part of a pledge to make its menu 50% meat-free by 2030. The fast food giant says the nuggets, made from soy and plant proteins, have been certified by the Vegan Society. Burger King hopes its meat-free target will help to reduce greenhouse gas emissions by 41%. Now, in 2021, it was estimated there were just over 4.5 billion social media users around the world. So that is 57.6% of the total global population. So what does this year hold for the world's social media users and the industry's giants? Well, let's discuss this with Jim Anderson, Chief Executive of Social Flow, which is an organisation that helps companies make the most of social platforms. Good morning to you and welcome to the programme. So what's going to be the dominant news when it comes to social media this year, in your view?
Well, it's hard to pick just one. There's so much going on in social media, as you indicated. I mean, it's all about the audience. You've got billions of people around the world consuming social media. We hear a lot about the criticisms, but a couple of things I would focus on. Number one, Facebook, more accurately now called Meta, the company, is going to remain enormously influential. Mark Zuckerberg, specifically, the CEO of Meta, he's one of the richest people in the world. He's young. He's younger than 95% of the U.S. Congress, if you go and look that up. And he's very much playing the long game. So I would look for Meta to continue to make significant investments. They're a $1 trillion U.S. Company, and they've got the resources to really sustain their momentum, even if Facebook, the application, continues to be under criticism.
But in the last... Sorry, in the last year, especially when it comes to Meta and other big organisations similar to Facebook, there has been talk about regulation, there has been talk about, governments cracking down on them. Your thoughts on that? Will we see more of that this year?
Yeah, this could be the year of antitrust. I mean, the crackdown could come in a number of different ways. EU regulators, of course, have been very aggressive against big tech. U.S. regulators a little bit less so, but I think antitrust is one of the few things in politics that can generate bipartisan attention, certainly in the U.S., and both Republicans and Democrats could get behind a breakup of big tech companies, specifically Meta, Google, aka Alphabet, or even Amazon or Apple, conceivably at some point. I think that the feeling is that big tech companies have too much concentrated power, and there seems to be at least an inkling of political will to do something about it. But normally antitrust takes years and years, if not decades, to unfold. So I'm not sure I would call 2022 the seminal year for antitrust.
And will the TikTok boom continue, do you think, in your opinion, which is interesting in itself, given the fact that this is a Chinese company, one that the previous Trump administration really tried to crack down on?
Yeah, it's funny you should say TikTok boom. I mean, that's really the possibility. I mean, boom as in, wow, it's incredibly successful. Young people love TikTok. It's amazingly popular. Their algorithms are fantastic. They know what interests you. So they're doing everything right. But they're still owned by a Chinese company. Your previous segment was just talking about the tensions between China and the West. And while former President Trump's executive order was ill-fated and perhaps ill-conceived in its execution, his attempt to force ByteDance to divest TikTok, the ByteDance being a Chinese-owned company, was not without its its plausibility and its reasons. I mean, there are national security issues, and just as China is concerned about its data in the hands of Western governments or Western economies, I think Western governments are concerned about their citizens' data in the hands of China. And the fact that TikTok says we have not been asked to provide that data by the Chinese government yet is really the big question. If that happens, or even if inklings of movement in that direction happen, I think that's enormously consequential to somebody like TikTok.
Okay, Jim Anderson, thank you for your time. Good to talk to you. And before we say goodbye, let's quickly look at financial markets in Asia. It's a mixed session happening in Asia following some declines on Wall Street the night before. So as you can see, flat in Japan. We've got Hong Kong down over 1%. The losers today are the tech stocks, interestingly. If we look at the next board, because the Nasdaq, the tech weighted index in the US, had an over 1% decline. Of course, this was following record highs the day before on Wall Street. So choppy times for financial markets as investors digest all the news that's coming in all the time, in particular in the US. What hit sentiment was the Omicron numbers and the more than 1 million new cases recorded in a day in the US, and that really hit sentiment on Wall Street, and it's going to be like that probably in the days ahead, I would imagine. A volatile time. Thank you for your company. I'll see you soon.